What is going on, traders? I hope you're all well. So in this video, I want to share with you one of my favorite setups in the market. Now, this setup is very simple. It works on both a macro and micro perspective. So in other words, it works on the higher time frames just as well as it works on the lower time frames. On the lower time frames, for obvious reasons, the moves happen a lot quicker than they do on the higher time frames. So this is something I use very often in my intraday trading system. So let's get straight into it. I've got two examples to share with you guys. The first example is on US30, which was a trade we capitalized on last week. I did share the setup before I entered here on TradingView and Telegram, and of course to our VIP Discord members. And then the second setup that I'm going to the second example I'm going to show you to you guys is going to be on GBPUSD, which again we shared with students via our Discord and here on Telegram and TradingView. So let's get straight into it. Before we show you the live examples, I just want to show you the methodology behind the setup. So for example, if the market is bearish, if we are trending to the downside, we have bearish order flow and a bearish draw on liquidity. Okay, you want to be looking for sells. The higher probability trade is to trade with the trend and look for the sells in the direction of the momentum. And one way we can do this is wait for an impulsive move to the downside, which breaks a level of structure. Okay, this confirms an indication of continuation of momentum. Once you get a break of structure inside of a bearish trend, you can see that you have an impulsive move. After an impulsive move, what you expect a corrective move. Okay, so the whole idea of this setup is wait for an impulsive move in a bearish trend. So wait for an impulsive move to the downside in this particular example's case, of a market that breaks a structure, a move which breaks a structure, and then simply wait for a corrective move. Inside of the corrective move, you want to see some type of consolidation. Okay, then you want to see a manipulation into a level of interest and a distribution back down. Okay, and this is exactly what we're looking for. Now, this was the accumulation which started to induce traders to go short here when really the institutional level to short from was all the way up here. So this particular bit of accumulation turned into an inducement because the market started to find resistance here. Okay, this induced retail traders, impatient retail traders, to open their shorts early, and this generated liquidity here. Institutional traders, as you'll hear me say time and time again, they can't simply buy and sell like we can. They need to generate enough liquidity for their orders to get filled. And one of the ways they generate enough liquidity for the orders to get filled is the market maker will set traps. These traps are inducements for retail traders. And this is a great example of one of the traps. Now, the accumulation phase in this accumulation, manipulation, distribution setup, the accumulation phase can look different. What do I mean by that? It can be a sideways range like it is now, or we could have exactly the same setup, right? But we could have a wedge consolidation, accumulation, whatever you wish to call it, okay, as the inducement. So we have the impulse, we start to get the correction, the market starts to trade inside of the wedge, okay, the market breaks the wedge to the upside. This stop hunts the traders that were shorting this descending trend line, and it also induces traders to open a trade in the wrong direction because they perceive a wedge formation once it's broken in either direction to continue in the direction of the breakout. Okay, and this again is just an inducement. The descending trend line creates liquidity to the upside of traders that are shorting the lower highs, okay, following that overall trend. They have just been tricked into the market, tricked into entering the market too early, okay, and it stop hunts the sellers. Not only that, but when you break to the upside, retail traders are taught that if a wedge gets broken to the upside, it's very likely going to continue to the upside, and that is completely wrong. The liquidity above the highs, above the descending trend line has been taken. So once they've been taken, there's a high probability that the next draw on liquidity will be to the downside to take the ascending trend line lows. Okay, so this is the setup that we're looking at. And essentially, all we're looking at is a bearish move in the direction of the momentum of the market, an accumulation of price just below or above, depending on the direction of the trade that you're looking at. In this case, it's obviously a bearish trade, so you're looking for an accumulation just below a higher time frame level of supply, a manipulation into that level of supply, and a distribution into the other side of the liquidity that was created during the accumulation. Okay, and that's the setup that we're looking for here. And like I said, the accumulation forms in different shapes and sizes. My favorite setup is the wedge. Okay, when I see this wedge like this is almost a guaranteed win, right? There's no certainties in the market, there is only probabilities. But when I see a setup like this with other confluences such as imbalances, okay, so say for example we had imbalance here to the downside, we had liquidity here, equal lows or something like this. This is a very high probability setup, one of my favorite setups to trade. Okay, so we've gone through um, some examples for you. Let's now have a look at some live examples, right? I've shown you the methodology, the ideology behind this setup and what you want to be looking for. So now let's go through some live examples and I'll show you exactly how we capitalized on these two setups with students. If we take a look first at US30, okay, if we take a look first at US30, what we can identify, let's just zoom out, right? Straight away, if you zoom out, look at this, we're in a bearish trend. The momentum is with the sellers. The draw on liquidity is to the downside. Okay, so now let's have a look at the most recent bearish move. Now we have a level of support here and here. This level of support got broken to the downside exactly here. Sorry, let me just adjust that. Okay, so this level of support got broken to the downside exactly here. So essentially what we have inside of a bearish trend is a bearish impulse from point A to B with a bearish break of structure. Now, generally speaking, after an impulsive move, what you want to see is a corrective move. You want to wait for the corrective move to occur, wait for price to come back up into a better level so you can get in a sell to follow the direction of the trend, the direction of the momentum. So in this particular case, you can see we made the impulsive move, then we started to make the corrective move. Now we have lots of liquidity here. This is liquidity because the market was trading to the side, okay, generating liquidity above and liquidity below. So first and foremost, what did the market do here? It pushed to the upside, right? So it took the liquidity above the highs. So where is the liquidity now? It is below the lows. We have equal lows. So we have nice liquidity residing below this area, first and foremost. The other thing that I can identify is we have imbalance here. We have 15-minute fair value gap from that wick high to that candle open here. Okay, so those two factors in themselves are indications that the price is wanting to move to the downside. The liquidity to the upside, as I said, has been taken. Now we have this level of liquidity to be taken here and this level of imbalance for the market to get attracted into. Okay, so how do we look for the short? You want to be looking for that accumulation pattern, either a range or a wedge. Now, in this particular case, what I can see straight away is we have a relative equal highs here. Again, what is that? Liquidity. Okay, so you don't want to be looking for a short until the buy side liquidity has been taken, until the liquidity above these highs have been taken. You want to wait for a manipulation, wait for a grab of liquidity above these highs before you can look for a short. Okay, so how can we do that? What we can identify here is, look at this. The market starts to form a wedge. Okay, so look at that beautiful bit of price action. We get the bearish impulse, the bearish break of structure. The market starts to make the retracement. At the high of the retracement, when traders are probably starting to short this level of supply, okay, this is the inducement. Traders think this is the level of supply that created the move, when really it's the level of supply up here. If you're an institutional trader, you want to be selling as high as possible and you want to be buying as low as possible. Okay, so a lot of retail traders, they don't have the patience and they end up getting in a trade too early. They end up getting stopped out. The market will hit their stop losses and then completely reverse in opposite direction. I'm sure that's happened to you guys time and time again, and this is one of the ways you can avoid doing so. Imagine if you saw this level of supply, you started to short at this level of supply because the market made the high, the lower high, the lower high. Imagine if you started to short this, right? Where's your liquidity going to be? Where's your stops going to be? Your stop loss is going to be exactly above these relative equal highs. That is exactly where the institutional traders have their entries. Okay, so what we can do once we spot a wedge in a move like this, you need to wait for a breakout. The breakout will confirm your bias. If the market breaks to the upside first, this means the market has taken this liquidity. So then the next draw on liquidity, the next area that the market should target will be the liquidity in the opposite direction. And that's exactly what happened. You can see here this wedge broke to the upside and it tapped into, first and foremost, this level of supply here. Okay, now we tapped into this level of supply, but we had no manipulation. You can see the market made a reaccumulation of price here. We started to consolidate. Now, US 30 in general, around 2:30 every single day, the market fucking moves. Okay, the New York bell opens, the London New York crossover, as you can see here with my indicator, the New York volume comes into the market, and generally speaking, the big moves on US 30 happen around 2 to 3 o'clock every single day, GMT. Okay, so what we can see here, the market started to accumulate. Then, boom, we get a manipulation to the upside. This manipulation finally mitigated that supply zone that created that bearish break of structure, which I mentioned at the beginning of this setup. Okay, so as soon as you get a manipulation of price, you've taken out the buy side liquidity and you've spiked into the order block, the higher time frame point of interest, in this particular case, the 15-minute POI, okay, in confluence with a psychological level 33,880, okay, that's your indication. And what you want to look for in this setup is a macro micro M. This is what I call it, okay? So you have a macro M here, okay, with the second leg above the high taking liquidity, and then inside of the macro M on the second leg, you have a micro M. And this is where you get stop hunts. Okay, the first M, which I've just shown you, the macro M, this move here is the stop hunt, and then you get the second stop hunt, which is this move here. You always want to wait for that second stop hunt, the micro M inside of the macro M. And this is a beautiful example of that. So as soon as you get the second stop hunt, in particular at that time, 2:30, off that level of supply, that's your entry. You get a shooting star candlestick here, which is a wick rejection. That would be my entry exactly there. That was my entry exactly there. And I took a short as soon as that candle closed. My target was the liquidity below these equal lows, the liquidity below this trend line, and this area of imbalance. My stop loss was well protected above the high, and as you can see, this was a beautiful trade to the downside. Very simple setup. This happened in one session, right? If you targeted the top of the imbalance, you got a 1 to 6, 1 to 5 risk to reward inside of one session. So that was a beautiful example with US 30. This is one of my favorite setups to trade. It happens all of the time on the lower time frames and the higher time frames. The lower time frames is particularly easier to capitalize on this setup than the higher time frames. The higher time frames, it can take a long period of time for this actually to play out. Okay, so that's an example of US 30 using a wedge manipulation as an inducement. Now what I'm going to show you is a example of GBPUSD, which is a trade we capitalized on last week or so, which again is an accumulation manipulation distribution setup, right? Exactly here. It's an accumulation manipulation distribution setup. However, the accumulation is now in the form of a range, a sideways range. Okay, so let's talk you through the setup. I'm just going to clean my charts a little bit here, so we still have some drawings. Okay, and again, this was a setup that we shared with students. So here, you just look to the left as always, right? What's the market doing? It's moving to the downside. It's making lower swing highs and lower swing lows. Okay, so we've identified the momentum, we've identified the trend. We are bearish, right? What do you want to be doing inside of a bearish trend? You want to be looking for sales. Where do you want to be looking for sales from? Do you want to be looking for sales from here? No, you want to be waiting after an impulsive move for a corrective move to capitalize on a continuation move. So here we have a level of supply. Why is this a level of supply? Because the market came into support, started to consolidate, then sold off. So we've got a bearish break of structure, a bearish impulsive wave exactly here. Okay, this is the level of supply because we have it accumulated here. This is the level of supply that created the bearish move to the downside. So ideally, what you want to be waiting to see, you want to be waiting for the market to come back up into the origin of the move that created the bearish break of structure, which is exactly here. This is exactly where we created the recent bearish impulsive move. So now if you have a look at the price action since the market created this recent bearish impulsive move, let's say this was a live example, right? What's happened here? The market's pushed to the downside. Okay, we have just confirmed a potential continuation of momentum because we have broke structure to the downside. We formed a new lower low. So what is highly likely going to happen now? We are going to form a new lower high and make a new lower low again, right? So how can you look at capitalizing on this? You can see the market came into this level, found support, and then found support again. Straight away, what do I want to see here? What have I spotted here? I've spotted double bottom liquidity. Okay, residing below all equal lows and equal highs is liquidity. So we've got double bottom liquidity here, but what have we got here? Right, we've got triple top or equal high liquidity. Okay, so if you just remove this and draw in a little box, right, what's happened here? The market has started an accumulation. We've come into a level of support and we've started to accumulate sideways. Now, the breakout of the accumulation is your indication of price. Which direction does the market break first? In this particular case, as we would expect, the market's broken to the upside. Why did the market break to the upside? Okay, there's a number of factors. One, because there is a massive liquidity void. It's not really in balance, but that whole level right there is a liquidity void. Okay, and that needs to get filled. The market needs to balance itself out. So the market's broke to the upside. It's filled in this liquidity void, this gap that we had here. In breaking to the upside and filling in the liquidity void that we have here, the market has as well taken out the liquidity above these equal highs. So the market's taken out the liquidity above the equal highs, filled this liquidity void in, overall bearish trend, overall bearish momentum. What is likely going to happen next? We're likely then going to target the liquidity below the equal lows from all the traders that are trading this double bottom formation. Okay, huge amount of liquidity below these equal lows. So how can we look at capitalizing on this? What you can wait for is priced to mitigate the supply zone, the origin of the bearish impulsive move. Does that happen here? No. We make a shift in market structure here because we broke below the previous 15-minute higher low that pushed the market to the upside, right? A lot of traders would have got trapped there. They would have entered short. When you saw that break in structure, they would have entered short here. Sorry, that's not a short. They would have entered short here. And that created the liquidity exactly where the institutional traders need to get filled, right? Which is how you're getting induced. So you want to be paying attention to the time. Look at the time this move occurred. It happened in between London and New York session, which is where the volume is a little bit thinner. The moves are manipulation moves. I only trade the beginning of the London session around 7 till 10 o'clock, and then I only trade the New York session between around 1 and 3. That's when the highest volume is in the market. Okay, so this was a manipulation because the market shifted structure to the downside before mitigating the supply. So you wouldn't have traded that. You wait for a mitigation of the supply. Okay, here the market mitigated the supply. Then we broke to the downside and we broke structure here. This was the last 5-minute higher low that created the sweep of the high. Okay, so we swept the high here. Then we shifted structure exactly here. Okay, how do you look for an entry? Where is the supply zone that created the shift of structure? It is exactly here. The next day, the market made the Asia session range. Above the Asia high and below the Asia low is liquidity. We simply set an order exactly at that supply zone which created the market structure shift. Stop loss well protected above the extreme, and our target was 10 pips below the range because the market likes to go for a 10 pip sweep, right? And just look how perfectly that played out, all inside of one day. Okay, and this is another textbook example of an accumulation, manipulation, and distribution. I hope you enjoyed the video, guys. Feel free to comment in below anything you'd like me to analyze or educate you on next. Don't forget to subscribe to our Telegram channel for more education, analysis, psychology, and more. Thanks, guys. Speak to you all soon. Take care.